Let's talk about the comments, Matt, because we're getting some really interesting comments
Yeah.
on the Gray Report, on the Gray Capital YouTube channel. I thought we could address those. Let's look at those first. So MS, let's read the comment.
He says, what about affordability? Historically, multifamily has performed well during periods of high inflation. However, considering that recent property appreciation was due to low interest rates and excess liquidity from stimulus checks, now we are increasing interest rates, and it would appear stimulus checks are a thing of the past. So no more stimulus checks, and inflation from food could mean less money available for housing. The multifamily portfolios between Section 8 and luxury could be impacted. The consumer can only afford what they can afford, and the trend of people moving back in with family in incoming years due to inflation eating away at purchasing power, well, that could really come to fruition. Those recent All In podcasts discussed multiple layoffs in the pre-IPO space, as well as some companies going bankrupt. With lower valuation multiples, VC money doesn't want to write down already existing investments, and there's just less of a runway. Doesn't want to write down existing investments, which would need to incur in case they participate in a subsequent funding round for the same company. Cash and burn and cash runway is becoming the most important metric. There are a lot of growth companies with cash runways of only a few months. Interesting times ahead. At the first sign of material Fed capitulation, all bets are off, and I will find a home for my cash. There's a lot of food for thought there.
Well, yeah, there's a lot to that comment. A lot of really good points, though. Multiple points, to say the least. Matt, you made a reply on the YouTube channel. We're pretty active on the channel. What was your response?
Yeah, I love comments like this. Actually,
pretty long here.
And I really
summarize it.
Honestly, it was a great, a thoughtful reply. I would direct him to our interview with Noah Stone, and it does talk about multifamily performance in different periods of inflation and interest rate environments, talking really about how the tech-heavy NASDAQ suffers the most, which tech-heavy NASDAQ, you would associate that with the growth stocks and these,
And a lot of that's because of the discount rate that, those tech companies are valued upon. Inflation goes up, the future cash flows are less valuable, essentially. So they're getting just a less attractive multiple.
Yeah. And these are periods of what Noah Stone and Jonathan Rappa in their report called quasi-stagflation. It's periods of low growth and high inflation. And this way, and so in that scenario, which is one the commenter described, multifamily really does perform better than the stock market as a whole and as NASDAQ, definitely. Now, his discussion about food prices and budget decisions that may impact it. That's not a foregone conclusion, but it is worth noting, and we'll dig into the actual numbers here, that food prices were up 8.8%, and rental housing, multifamily housing, only up 4.4%. So that's half of that. Yep. And 8.5% for all items, but still rental housing is low compared to CPI as a whole.
So I guess the question is, on one hand, you could say, okay, there might be some room for growth for housing, but I think what his comment is you can't squeeze any more blood out of a turnip. Like there's no more money to. The affordability is such a factor. You can't pay anymore for rent.
Well, and that's something that I put in some of our show notes when we were talking about when we talk about the CPI and specifically is housing is such a big chunk of people's budgets that a small little move in the price of housing has an outsized effects on people's budget. So, bread a little bit more expensive or like a sweater is maybe more expensive, but the change in the price of your rent, the change in the price of the house, which you can't get around it, that's going to really have a big impact. So that 4.4% does a lot of heavy lifting when it comes to people's budgets.
Yeah.
And then finally, my other response was basically, saying a lot of the rising valuations of multifamily property is due to continued investor attention.
Yeah.
Investors I think it still remains to be seen whether we're going to see a significant cooling off due to interest rates, because there could be a scenario in which investors looking at a recession continue to come into the multifamily market because it's a historical hedge against inflation.
Yeah,
and other economic volatility.
We're still seeing that. I mean, definitely we're seeing a little bit less of just the incredible speculation, because a lot of people, they're just not able to get the financing put in place because interest rates have moved and they can't clear that debt service coverage ratio hurdle. And so having to do lower leverage, which, does not allow them to pay up as much because they got to put more money down. So there's that headwind. But to your point, there's so much capital, so much dry powder floating around, sloshing the systems. Even still, I mean, I think at the end of 2021, there's about $250 billion of dry powder earmarked to multifamily investment that's like already been allocated. It just needs to find a home, and they'll take lower leverage in order to get allocated because they do see the long-term growth potential. I think one other good question that the commenter asked was, okay, how about luxury properties and Section 8? Then he was really getting into kind of the slowdown in kind of the VC space in those technology companies, seeing those pre-IPO companies now with a lot of runway, less investment, and seeing some layoffs. And so it will be interesting that in maybe some of those kind of really strong, maybe like really just tech-centric markets, maybe so like your San Francisco's, your Austin's, even Salt Lake City, Boston, where a lot of those startups are. Potentially, you could see some softening. Counterpoint to that, though, is we are at one of the tightest labor markets, in decades.
It continues to be, people are rightly so talking about recession and inflation, but it's like the job numbers haven't reflected that yet.
It's still tight, and I think they're good points though, and I think that's where you want to be careful on some of these really high flying, high growth markets because you could see a little bit of a correction just because they are so high flying. Now, over the long period of time, I think they'll kind of continue their growth. But right now, if tech is going through a slump, you may see some softness. Now, I think there's still a lot of those jobs, and those are all high-paying jobs, and so maybe they're not getting, the $250,000, the $500,000, payday. Maybe it's $150,000. Still can afford some really nice rent, assuming that they can actually find a job.
And the reports really this week really bear that that assertion out. Is that these ultra popular markets, they're not going to see the same amount of rent growth this year as they did last year, whereas the more stable markets are going to do a little bit better this year comparatively in terms of the proportion of last year's.
And one last point I would like to make on kind of the luxury Class A side, because I've had a couple people ask, like, well, this could be maybe bad for those high-end apartments. I really see it as the opposite, but it really relates more to the single-family home market and the housing affordability, because you've got a lot of people making a good salary, they've got a good income, they even have some cash, but they either can't find a home or that 5.5% to 6% interest rate to buy that home. They're like, maybe I just might take a break and rent for a couple of more years, which really grows the renter pool. And Yahoo News, there was actually an interview that maybe we can look at on the next week's report, that they've talked about that, of how they're predicting, and this is really research coming out of Zillow, they're predicting still positive single family home growth over the next several years. And their conclusion, that's going to drive a lot of people to stay renters and even grow the renter pool over time. So on one side of the economy, maybe, or really housing market might be cooling down a little bit, but that still can be a driver for rentals as well. And it's a little counterintuitive because you're like, recession's bad, recessions are bad. It's not good for anybody. It's more volatility, but that's why our apartments are in this great sweet spot, because you have people kind of moving down through the economic ladder. And there are rentals at multiple stages kind of along that ladder. So you lose your job and maybe you move out of that luxury apartment, or you have to move out of your single family home or your single family rental. You move into an apartment. Maybe you move from A to B class or B to C class.
And recession wouldn't be good for the apartment. But there are counter forces in the apartment market that could kind of bolster rent growth or maybe create a little bit more stability. Whereas in a recession may directly impact. There's no counterbalancing force in other markets.
Yeah, when people have to start making sacrifices, and maybe they're not spending that that Starbucks coffee. Maybe they stop taking all the doing all this traveling, because traveling is, everyone's traveling around. People are spending a lot of money right now, on luxury goods, especially trading, tradables, collectibles, all kinds of stuff that people don't need. You cut all that out, and you still need a place to live and prioritize housing. We saw that in the pandemic, and that's where 100% agree. Recessions aren't good for anything in real estate, but where apartments are, they're just a little bit insulated. We kind of have that stopgap, that stop loss, because it's just people need a place to live, and the kind of the middle and the higher, kind of quartiles of income earners, they're pretty well insulated anyway. In a big chunk of those, looking for a house, can't find it. Don't want to put the down payment. Don't want to pay the interest rate. Some of these nice new apartments look like a pretty good option. Yeah,
I think that will be interesting to see because, the Fed, it seems easier to think that the Fed may have temporary, they change things rather than inflation. That's going to be a very persistent, kind of a long-term movement.
Yeah. All right, let's move on to one of the first reports. And again, if you want your comment talked about on the Gray Report, leave a good comment below this video or any of the Gray Capital videos or Gray Report videos. We will be sure to certainly reply to it, but if it's a good one, we'll feature it on the Gray Report. All right, next report up, Marcus and Millichap. What a hawkish Fed means for CRE investors. Matt, you want me to play this video or just in the background, or you just want to hang out and talk about it?
We could just hang out and talk about it. I just wanted to note a couple things from this video.
I'll do a little bit of both.
That's fine. He says, the Fed's plan for quantitative easing is intended to reduce the possibility for a yield curve inversion, but kind of already happened.
Yeah.
So I don't understand what the logic is here. Maybe there's some kind of recursive kind of time travel sort of thing, but
yeah, that makes sense.
I would love to see what the logic is to prevent something that happened in the past. But maybe this does mean that it avoids the severity of a recession that's signaled by the yield curve inversion. However, the possibility, they say, of a recession is elevated, but not a foregone conclusion.
Yep.
And like we said, like we noted earlier, there's been great job growth, wage growth, really retail sales growth. They all seem to highlight inflation risk more than recession risk. Yeah. But really the pullout for this whole video is rate hikes. That's the discrete thing that we can point to. These rate hikes are something that you got to be ready for. They say that all this hawkish stuff from the Fed is to avoid recession, but I sure hope it doesn't tip over and cause one, because these are the real huge data points that we got to watch rather than this. There's a potential for a recession. We have to be ready for it. But right now, the rates are rising, and so if you don't have a plan for that right now, then
and I think a lot of it's been priced in. Although it seems like the stock market is a little bit late to the game to kind of price in the full maybe 200 basis point move in the Fed funds rate. But you have to be pricing it into your underwriting and what your projections are going to look like, and that's going to be bringing down returns, which certainly could be softening the market. But to your point, the big question is the Fed going to basically create a recession? And they said basically we're going to tighten until something breaks. Now, one concept that I've been kind of toying around, back here in my mind recently is it's really kind of a concept of almost like the fourth form of monetary policy. Really the Fed is supposed to only have kind of two major tools, moving the Fed funds rate and, kind of quantitative easing, kind of buying treasuries and securities. The third one people talk about, you'll hear Ray Dalio talk about this, is kind of more like fiscal policy, which that's Fed's monetary, not fiscal policy, but kind of encouraging, governments to spend money essentially to drive growth and, increase the velocity of money.
So like treasury stuff.
Well, just spending money, infrastructure bill, just spend on whatever. Spend money. Now the fourth, which I think that is talked about kind of on the margins, is really all rooted in psychology. Because as we know, inflation and the markets are much more being driven by psychology and sentiment and people's collective opinions on things. Yeah. And we all know how powerful the Fed is, not necessarily what they do, but what they say. Oh, yeah. And may move markets just by, hinting at a few things. It'll move markets, significantly. Like Fed Governor, Brainerd last week was talking about they're going to move very hawkishly on tapering their balance sheet, unwinding the balance sheet, which is just massive right now. That moved the markets significantly. They've only moved the Fed funds rate. The interest rates that the Federal Reserve controls are still incredibly low.
Yeah.
So like interest rates have risen on more of the market dependent and influenced longer maturity, bonds like the, kind of the 2-year all the way up to the 10-year and further. Those are much more dependent on market forces. The market has priced a lot of, increases in on that. That's why the 10 years up at, 2.7% down from, 0.5% back in 2020. But there's still a lot of room to move on the lower end of the curve. And so I was asking myself, how much does the Fed actually have to do? And are they really, is part of it a bluff?
Yeah.
In a sense, they don't really want to move the low end of the financing rate. They don't want to move those short-term financing rates for a couple of reasons. One, it's what a lot of the major institutions and the banks, that's what they're borrowing at. And they want to keep those major institutions. They want to keep the liquidity flowing around. Banks, they borrow short and they lend long. So right now, if you're borrowing short at a low Fed funds rate, that's right now, 0.3%, and you're lending out, we're at the 10-year Treasury at 2.7 plus whatever spread they're going to charge, that's a profitable proposition.
Yeah.
You bump that Fed funds rate up, all those big institutions, it becomes much less profitable, and a lot of loans floating loans are based on that shorter term rate. So active investments, not just real estate, all throughout the economy, you move that shorter term rate, that can really that can throw a wrench in the gears. Much more than the longer term rate, because the longer term rates, like the 10-year Treasury, that's what is used for really fixed rate financing, fixed rate mortgages, fixed, for a single family home or for an apartment building. So, that affects you when you're going to be locking in your rate today, but it doesn't affect someone that locked their rate in last year. So, you're kind of going into that you're going to get a higher rate, and it still works, and you're not caught off guard. But if the lower rates get moved significantly, and the talk is them being raised another 2% or 200 basis points, it's projected that at the next Open Market Committee meeting early in May, they're going to raise it another 50 basis points, so it'd be around 0.8%. If that continues to move all the way up to 2%, that could be pretty destructive to liquidity and financing. And I don't think that the banks want that. I don't think the Fed wants that. And so the question is, they'll do it if they have to, if they're forced to, mostly because of political pressure and societal pressure of like inflation is just too high, we need to get rid of this. But let's keep in mind, the Federal Reserve actually likes inflation because it actually destroys the debt. The federal government likes a little bit of inflation because it erodes the value of their sovereign debt. Now, the only reason why they really have to raise it, in the wealthy, they're fine. They're fine. Inflation isn't going to get them. They're invested in assets. They're invested in real estate. The only reason why they need to raise it is because the 90% of people who are affected by inflation, they're not making $1 million a year. Their wages aren't keeping up. And they're saying food's going up in prices, gasoline's going up in prices. So it's a political problem to raise that interest rate. But the Fed really doesn't want to if they don't have to.
Yeah, I would say I would agree with that. I would also, I keep thinking about, interest rates were not always zero, going through the pandemic. So what was the economy like, in 2018? Well, not 2018, because that's the taper tantrum. But
that's the last time they raised interest rates is when they really started rising in 2018 and started cooling the market. And that's when the yield curve inverted. That led to the yield curve inverting in 2019, which pandemic happened, but we still had a recession. Yeah.
So, it's hard to see anything else. It's going to cool down from zero, but it's also, it was always signaled.
Zero is free money. It was like literally pumping free money into the system.
So I wonder, what's the sweet spot anyways? And you can't expect it to be zero forever. But I do, we have talked about this before. There's a long-term trend, of lowering interest rates, or so I don't know where that's supposed to go.
They're raising it so they can lower it again, basically. Yeah. And the truth is, the global economy and governments and institutions and banks are addicted to cheap and free money. Like it's a literal physical addiction to cheap money, and that's where the Federal Reserve, again, they will if they're forced to because of political pressure. How much do they really want to? They're hoping that the market solves their problem for them. They hope that on the longer end rates, they get priced up. There's enough, volatility in the market, in the stock market kind of corrects even further. to where where they say, well, we no longer can continue to raise rates because the markets are in turmoil and we just can't do it right now. That's what they want to have happen. They don't want to be the ones that lay down the hammer.
Yeah.
But they're the ones to do it, and they have a history of wrecking the economy. Because the position that we're in right now, and you could argue that it was necessary to create all that liquidity, but the position that we're in right now is in the inflation that we're seeing is because of monetary policy 1, 2, and 3.
Yeah.
1, because they lowered interest rates basically to 0. 2, because they bought up treasuries, mortgage-backed securities, and even stocks and all kinds of assets. And 3, fiscal policy. Trillions of COVID money, infrastructure.
Yeah.
Now we got a war in Ukraine. Defense spending is not going down. So all of those three tools, even the third one, they're not really supposed to be involved in. They're all in full gear. And so now they're using this, what I'm calling monetary policy 4, which is psychology, using basically, psyops essentially to say, what can we just say? Go out there in the public, say a few words, and can that wreck markets to a point where now it is not politically feasible or politically acceptable to raise rates and further hurt the economy, because they say it would be disruptive to the economy. And again, they're just looking at political pressure at that point.
Their impulse initially was to lower rates during the recession. Not a whole lot of people were complaining that much.
Yeah, free money. They were handing out not only like our commenter said earlier, stimulus checks, but the stimulus checks that's like the small tip of the iceberg. And there's a meme that's floating around. It's like you traded in, you got your $1,400 stimulus check, but what in return what you got is 10% inflation and high gasoline prices, high housing prices, and hope you enjoyed that $1,400 because now you're paying double, triple on everything else. And this is exactly, this is how it works.
It's a little bit of an oversimplification.
It is, but it's kind of the truth. Also, these high prices. There's a lot of factors, but creating more money than has ever been created in the history of the Federal Reserve in a 2-year period. Yeah, if you don't think that has an effect, I don't think that we're looking at the whole problem in itself.
Yeah, it's a naughty. I'm glad I'm not on the Fed board, because you wanted to help people during the pandemic, and and they probably knew that this was going to happen. Yeah. What else could you do?
Yeah, and that's what I was saying. I don't know what else you could have done. It's probably the right decision, but I think then we spent a lot of it on the fiscal side. I think we just spent a lot more money. They probably bought.
That's
more. In retrospect, there's not the need to buy all these mortgage-backed securities to add liquidity. That market was fine. Yeah. So I think that they overreacted a little bit. They did overreact. They called the whole idea of transitory inflation completely wrong. It's not transitory. So they've missed it twice, and now they're saying they're going to be able to create this soft landing, which I think is possible. I think the market might fix it for it. I think that's certainly a possibility. But the Fed doesn't have the best track record of these types of soft landings, and that's why we just need to take preemptive measures to when we're looking at deals. Because again, the multifamily investment thesis has solid fundamentals. Mm-hmm. We got to position in the right way and build these business plans in a way that we can weather any kind of storm in the short term. Yeah, and I think it's going to be a short term. If we have a recession, I think it's going to be a relatively quick one. And we're going to see positive growth on the other side. So if you have the ability to again weather the storm, batten down the hatches, and get through, I don't even know if we're going to see much of a price decrease. I think we're going to see a decrease in price growth over the next couple of years. And a lot of that is going to be driven by the rent growth we're seeing. Because interest rates can go up, but if you've got rent growth that's outpacing, it becomes less important. It's not as important. It's still important, but it's not as important. If you don't get the growth, that's where you have a problem.